Okay, and let me see. It was I think it's one of the shortest ones I had done. So let me just check this. Any questions?
Ramin, I had a question.
Of course. I just haven't missed.
So I was gonna ask, is this like common within like hedge fund managers and portfolio managers? You know,
Oh, yes. I
like
mean,
how they like sell puts to hedge. Is this as common as that?
well, that's a little different. So as a portfolio manager, you prefer to do uh, basically hedging using, let's say, futures, and that's a different story. When you have a portfolio, um, let's say you have equities and very much correlated to S&P, then you go ahead and short the SPX, for instance, or you short futures on ES. So that's talking about large amounts. This is more of a actually a strategy to manage the times that you really want to be in the market without really uh, taking a lot of risk. And that's actually strategy on its own. So the pure hedging is similar to this, again, because if you have, as I mentioned, your long equity, you can do that. But this has its own taste. As I mentioned, it's very popular to do two similar assets. For instance, I just used like Coca-Cola and Pepsi, or Home Depot and Lowe's. That's a strategy. You can actually long one because it's overvalued and then short the other one. So basically that's the type of the investments or trading you could do. So it's not really for most of the portfolio management. It's more of a taking advantage of what's going on and making extra profit or income. So it will be, in the trading arena more so than really portfolio management arena. Is that helpful, Lucas? Does
Yes,
that make sense? Yeah, I
definitely.
mean, this is especially for you, like our group. This will be, I think, an ideal situation. And one of the things most of you have noticed, I mean, I do gold and silver, for instance. We look at the historical average, let's say past 20 years, and we say, well, gold for the past 20 years, the ratio has been, let's say, between 74 and 78, or let's say 80. When the ratio goes to 90 or 95, you're really overextended. So if I'm going to do something, there's a couple of things I do. If I am bullish and have a bias on a long cycle precious metals based on fundamentals, do I want to buy gold or do I want to buy silver? Obviously, silver is undervalued. Now, the question is, what if my fundamental ideas are not completely correct? And let's say both of them go down. So this way, what you want to do, that's why the pairs trading becomes attractive, because you kind of limit your losses or kind of becomes neutral. Granted, both are going down, so you will make money on the gold side while you're losing money on the silver side. So, but the same thing we talked about last week with the Brent and WTIC. You could see there was like in February when we had this big spike on WTIC, that was the time perhaps to do a pairs trade, or at least if you want to do, you would think that, all right, maybe oil is overextended. If I'm going to short one, why don't I short the one which is overvalued? And that would have been WTIC rather than, like, say, Brent oil. Okay, so that's how
Okay.
you could use the ratio or, the pairs trading.
Got it. Thank you.
You're welcome. Any other question? I mean, is this something you would be interested in? Like, I don't, next week, as I mentioned, I want to go dive in to, and the mechanics, I couldn't split it. I couldn't do like an hour and then do 40. You got to have it continuous. So I thought we'll do it that way. next week. So
I,
anything?
I
Yes.
mean, yes,
Yeah.
definitely very interested. Just two questions quickly. About a year ago, you showed us, I'm just wondering if it's a similar thing where you had a variety of products that when they diverged, you would trade so that they came back together. Do you remember that?
It was,
Yeah,
with IWM. I remember
Yeah,
those.
TZA, right?
Yeah,
So we had a level. So you have to be a little careful. Yeah. So what we will use, that one was the spread when they diverged
Yes,
so
yes.
far. So it wasn't means that one you have to be proactive, and also sometimes the problem with TZA is a leverage, right? So it's a TNA and TZA, for instance, and I use FAS and FAS, for instance. So those, they work well when really stretched, and I use the spread of 3 times, for instance. So I would, but yes, it's absolutely the same way. It works well with a lot of commodities. It's just the leverage, you really have to be on top of it, because again, it's triple leverage on both. The same thing with FAS and FAS.
Right.
Now we have the it's the TQQQ on NASDAQ, SQQQ on NASDAQ. You could do that the same way, but it's more proactive on your side. And that's when we see the extension, the rubber band stretch. I will show you a couple of indicators next week, how we know that the standard deviation is like out of whack, and when it's time for them to revert to the mean. But you're absolutely right. Yes, it is. I didn't mention, next week maybe look at it. I used to do, and I think some of you have been with me long enough in the past, that it would be like crude oil and gold. Very interesting pair. And because they're very much like dollar related, I used to use when they really had a big divergence. And then I would think, oil priced in gold, is it undervalued? Is it overvalued? As we use like S&P pricing gold, for instance. So that was another thing you can do. Gold is a good standard. There's a suggestion is this time maybe use Bitcoin versus gold, and using that. Again, we don't have a lot of history, and that's what it creates a volatility, historical volatility that not 100% reliable. But maybe in the future, that will be something we can take a look at, and based on the ratio to see if there's been any undervaluation, or the assets, can we use both? And but yeah, so different, you can do cross, as I mentioned, commodities as well. So,
and then when you're using correlations to calculate the correlation, what time period do you use? How far back do you go to calculate a correlation?
Excellent question. That's part of our mechanics.
Oh, next week.
Next
Okay.
week. But
Okay.
I will give you hands up. The back. But so that's an excellent question, Jean-Claude, because what we want to do, we have to look at, I call them multi-time frame, because there are sometimes spikes on these correlations. So we want to have a harmony. So if you're doing a little shorter term, so I like to look at 3 months, 6 months, and 9 months. I can go back to 2 years, but I do not just, and that's an excellent question. You don't look at like a 3 months. It's, oh, what a great correlation. Well, it's for this, maybe it's the seasonality at this time. That's what so we look at 6 months, 9 months, you can even go a year. So definitely that's one of our criteria. You're ahead of me, is you use a multi-time frame to validate that. Okay. And if you look at, like, for instance, again, Home Depot and Lowe's, you see, or the Walmart and Target, you will see these divergences. But a lot of times, even look at Exxon and XLE, for instance, they usually follow, but they are not harmonious all the time. The other question you will ask is, what correlation is valid? Is that 100% a good correlation? Not really, believe it or not. You want to have enough value to make sure the movement will have a little divergence, so you could have the profitability margin. So just give you an idea, it's like somewhere around 0.8, 0.77 is ideal for gold and silver, 0.8. On the other hand, you don't want to have something that has a 0.4 or 0.2. So those correlation numbers are also important. So which one gives you the best buck for your bang? So
Got it.
or bang for your buck.
Mhm.
Anyway, is that helpful?
Yes,
John?
very helpful. Thanks, Ramin.
You're welcome.
Yeah, looking forward to next week's class.
All right, sure. Thanks. Any other comments or question?
Ramin,
Yes, Andy.
I was thinking, could you use like a relative strength indicator to spot the divergence? So like
Absolutely.
if you see the RSI, you know, going up or down.
Yeah, so no, you don't use RSI because relative strength index is against each other, itself. So you would use RS, the relative
RS.
strength. No, the RS is compared to S&P. So that would be your criteria. But there's something called relative value, which it is not almost like ratio, and TOS has it. I'm not sure if TradingView has it, but you can actually see these two, again, the relative value. And I will show you different ways to do this. So relative strength, you want to see that there's a divergence. And that's how you will find out one is moving away from. Also, I will show it again next week. There's the beauty of this is it's visual, so you can actually visually see.
Yeah.
But there's also indicators that, as I said, like Tasty Work or like Thinkorswim, they have that they allow you to pinpoint. Okay, there is undervaluation or overvaluation. So,
Okay.
I mean, especially the markets we are in, and sometimes you don't want to risk. You want to be in the market, but you don't know what to buy. So that's a pairs trading becomes attractive to be involved.
Okay, thanks. So
Yeah.
maybe we could have like a follow-up class where we can.
Yeah, so that's again next week we will once we do that, then hopefully that will be more clear and we see how actually mechanics work. So that will be-
Okay. Also, do you sell options based on strategy or?
Okay, so basically now you're again ahead of yourself. I mean,
Okay, sorry.
but that's okay. So that's why you can actually use this, and we can create a credit spread.
Okay.
We don't want to do, again, the idea is we want to minimize risk, right? So we don't want to go selling naked but you can actually, you have a credit call spread and credit put spread. And that creates what we call split iron condor on different asset classes. You remember iron condor is in the same asset. Well, it sounds advanced, but it's a similar idea. But I will share that with you next week. But you absolutely, yes, you could, but I wouldn't do. You just have to very much protect yourself.
Okay.
Make sure you have limited risk. But you sure can. Any other questions or comments? I think this was the shortest class that but it would have been the shortest or it would have been the longest. So I thought we split it anyway. All right, with that in mind, if no other questions, I just want to again mention that due to my traveling Saturday class will be very difficult coming to you from New York because of the time difference and with my daughter's situation, we are supposed to attend her event at the university. And so with that in mind, I'll have some ideas, I'll send it, but most likely I won't see you at least live. So if that's my apologies, I think I really don't like to miss classes, especially market analysis. But be aware, we have the Jackson Hole this week, starting tomorrow, and then, watch it for Friday, obviously, the speech by Powell. So the markets are on the edge, so they like to hear what's going on. And then if there's no further questions or comments, I very much appreciate again being with our group and paying attention. I look forward to seeing you next week. Have a wonderful rest of your week, and I'll talk to you soon. Bye now.
Thank you.
Thank you. I
Ray.
mean,
Thank you.
bye-bye.
Safe travels.
Thank you very
Safe
much.
travels.
Thank you. I know.